On Friday, October 24, 2025, the Dow Jones Industrial Average closed above 47,000 for the first time ever. This historic moment marked a new chapter in the story of American finance, as the iconic index shattered yet another psychological barrier. The trading floor erupted in celebration, with traders and investors alike pausing to recognize the significance of the milestone. For many, it was a day that will be remembered for years to come, a testament to the power of perseverance and optimism in the markets. This wasn't just a small step, it was a giant leap, signaling surging investor confidence. The mood was electric, as investors across the country watched their portfolios climb higher. The rally was fueled by a sense of renewed hope, as positive economic data and strong corporate earnings combined to push stocks to new heights. For many, it felt like a reward for months of patience and careful planning. The Dow finished up more than 470 points, closing at a record 47,207. This impressive gain capped off a week of steady advances, as investors digested a steady stream of encouraging news. The closing bell brought cheers and applause, as the numbers flashed across screens in homes and offices nationwide. The S&P 500 and Nasdaq Composite also hit new all-time highs, confirming broad market strength. It wasn't just the Dow making headlines. Other major indices joined in, reflecting a wave of optimism that swept through the entire market. Analysts pointed to the breadth of the rally as a sign that the economic recovery was gaining momentum, with sectors from technology to manufacturing all participating in the surge. This rally reflects months of economic progress, corporate innovation, and shifting expectations. Companies have been investing in new technologies, expanding their workforces, and adapting to changing consumer demands. The result? Stronger earnings, higher productivity, and a renewed sense of purpose in boardrooms and on factory floors alike. The market's rise is a reflection of this underlying strength and adaptability. Just a few years ago, 47,000 seemed out of reach. Now it's reality, showing the resilience of the American economy. The journey to this point has been marked by challenges, from global uncertainty to domestic setbacks, but the market's ability to recover and thrive is a testament to the enduring spirit of innovation and determination that defines the nation. For anyone with a 401k or IRA, this milestone means your savings are growing. Retirement accounts have seen significant gains, offering reassurance to millions of Americans planning for their futures. It's a reminder that long-term investing can pay off, even through periods of volatility and uncertainty. The spark? A government inflation report that came in cooler than expected, changing the outlook for interest rates. Lower inflation eased fears of aggressive rate hikes, giving investors confidence that borrowing costs would remain manageable and economic growth could continue. Next, we'll break down what that report said and why it sent the Dow soaring. Stay with us as we explore the details behind this historic rally and what it could mean for your investments in the months ahead. The hero of this rally? It wasn't a single company or a hot new tech stock. Instead, it was a number that Wall Street has been watching with bated breath for months. The Consumer Price Index, or CPI, is the government's main measure of inflation. It tracks the prices of everyday goods and services, from groceries to gas, and gives us a snapshot of how much more, or less, we're paying compared to last year. The September CPI report, which was delayed by a government shutdown, finally arrived, and it brought some much-needed good news. Inflation rose just 0.3% for the month, which was less than most economists had predicted. That small difference might not sound like much, but in the world of finance, it's a big deal. On a yearly basis, inflation is now running at 3%. That's not only below forecasts, but it's also a sign that the relentless price increases we've seen over the past couple of years are finally starting to cool off. In the world of finance, even a fraction of a percent can move markets. These small differences are huge, signaling that the fight against rising prices is being won, at least for now. Investors and analysts alike have been searching for any sign that inflation is under control, and this report delivered just that. Even more encouraging was the reading on core inflation. This measure strips out the often volatile prices of food and energy, giving a clearer picture of underlying trends. Core inflation also came in cooler than expected, suggesting that the slowdown isn't just a fluke, it's broad-based. This is the number the Federal Reserve watches most closely when deciding what to do with interest rates. A lower core inflation rate is a strong signal that inflation is moderating across the economy, not just in a few isolated sectors. For investors, this was a huge relief. After months of worrying that the Fed would have to keep interest rates high to tame stubborn inflation, the latest data suggests that the worst may be behind us. The pressure is finally easing, and optimism is returning to the markets. For much of the year, markets have been on edge, fearing that the Federal Reserve would keep rates elevated for longer than anyone hoped. High rates make borrowing more expensive, slow down economic growth, and can even trigger recessions if they stay high for too long. But this report changed the narrative almost overnight. Now, investors are starting to see a path to potential rate cuts in the near future, which could make borrowing cheaper and help fuel more growth. That shift in thinking unleashed a wave of buying across the stock market, pushing the Dow to record territory. It's a reminder of just how powerful economic data can be in shaping investor sentiment and market direction. So, why do rate cuts matter so much? Let's break down what they mean for the economy, for businesses, and for everyday people like you. The Federal Reserve's main tool is the federal funds rate, the interest rate banks charge each other overnight. Higher rates make borrowing expensive, slowing the economy to fight inflation. Lower rates do the opposite, fueling growth. For 2 years, the Fed has been raising rates to tame inflation, creating headwinds for stocks. The latest CPI report was the signal investors wanted. Inflation is cooling, and the Fed may soon cut rates. Immediately, Wall Street's mood shifted from cautious to celebratory. The odds of a December rate cut jumped to nearly 99%. Lower rates mean cheaper borrowing, more investment, and higher corporate profits. That's the fuel behind the Dow's historic climb. When rate cuts are on the horizon, optimism sweeps the markets, and for good reason. Lower interest rates are like rocket fuel for stocks, setting off a chain reaction that touches nearly every corner of the financial world. Investors know that when borrowing becomes cheaper, companies can access capital more easily, fueling expansion, hiring, and innovation. This anticipation alone can send waves of excitement through trading floors and investment firms. Lower rates make future company profits more valuable today, boosting stock prices. When the cost of money drops, the present value of future earnings rises, making stocks more attractive compared to other investments like bonds or savings accounts. This shift in value encourages investors to move their money into equities, seeking higher returns. Sectors like banks and tech benefit most. Banks see more lending and fewer defaults, while tech firms can borrow cheaply to innovate. Banks thrive as more people and businesses take out loans, and the risk of borrowers failing to pay back drops. Meanwhile, tech companies, which often rely on financing to develop new products, can accelerate their growth plans. On Friday, major bank stocks like JP Morgan and Goldman Sachs rose around 2%. Investors recognize that these financial giants stand to gain from a friendlier lending environment, and their shares responded quickly. The tech-heavy Nasdaq surged to a record high, as investors paid a premium for future growth. With lower rates, the promise of tomorrow's profits becomes even more enticing, especially for fast-growing technology firms that are shaping the future. Lower rates also trigger FOMO, fear of missing out, drawing more investors in and pushing prices higher. As headlines tout new records and social media buzzes with excitement, even cautious investors feel the urge to join the rally, adding more fuel to the fire. This creates a self-reinforcing cycle of buying and rising prices. As more people jump in, momentum builds, and the market climbs even higher, sometimes faster than fundamentals alone would suggest. On this historic day, data, expectations, and emotions all aligned. Analysts pored over economic reports, traders watched for every signal, and the collective mood turned bullish, amplifying the rally. The result: the Dow crossed 47,000, a milestone that captured the world's attention and symbolized the market's renewed confidence. But which companies led the charge? As the dust settles, all eyes turn to the standout performers driving this historic rally. Tech and financials were the engines of this rally. Alphabet jumped 2.5% after announcing a major AI partnership, reinforcing big tech's dominance. Apple hit an all-time high on strong iPhone sales. AMD and IBM soared after a quantum computing breakthrough, while Intel surged 7% on strong sales. Banks like JP Morgan, Wells Fargo, and Bank of America climbed as lower rates promise more lending and fewer defaults. When tech, representing future growth, and banks, representing economic health, rise together, it's a powerful sign of market confidence. But it wasn't just these sectors making headlines. Ford Motor Company surged over 10% after crushing earnings expectations, a rare bright spot in a tough auto market. Coinbase gained 3%, boosted by a JP Morgan upgrade, and Bitcoin's rally above $110,000. Not all news was good. Deckers Outdoor, parent of Hoka and UGG, plunged 12% after lowering sales guidance due to tariff concerns. This shows that even in a strong market, individual performance matters. Overall, third-quarter earnings have been stellar. 87% of S&P 500 companies beat estimates, and 75% posted double beats. American corporations are proving more resilient and profitable than many feared. But the market mood is shaped by more than just earnings. Market sentiment is shaped by more than numbers. Politics and global trade matter too. This week, a brief US-Canada trade spat over a TV ad was quickly resolved, calming investor nerves. There were also positive signals from US-China trade talks, with hints at possible tariff reductions. Investors crave stability, and any sign of smoother global relations is a boost. Meanwhile, a US government shutdown has delayed key economic data, but markets remain focused on inflation and earnings. Still, a prolonged shutdown could hurt confidence and slow growth. For now, optimism prevails, but political risks remain. So what does this milestone mean for your money? If you're invested for the long term, the Dow's new high means your savings are growing. It's proof that patience and discipline pay off, even through volatility. But don't let a record high tempt you to change your strategy. Stick to your plan, based on your goals and risk tolerance, not daily headlines. This milestone is a checkpoint, not a finish line. It's also a reminder to understand what drives markets: inflation, rates, and earnings. Knowledge helps you avoid emotional decisions. For those still on the sidelines, remember, markets hit new highs often, and waiting for the perfect time rarely works. The key is time in the market, not timing the market. Start investing consistently and let compounding do the rest. With the Dow above 47,000, the big question is, what's next? The focus stays on inflation and the Fed. Future reports will be crucial. Next week, a third of S&P 500 companies report earnings, including tech giants like Alphabet, Microsoft, Meta, Amazon, and Apple. Strong results could push the market higher. Weak outlooks could trigger a pullback. Meanwhile, consumer sentiment is mixed, and some companies are announcing layoffs. The disconnect between Wall Street's optimism and Main Street's caution is worth watching. Still, this milestone is built on cooling inflation, strong earnings, and hopes for lower rates. Enjoy the moment, but remember, building wealth is a marathon, not a sprint. Stay informed, stay disciplined, and keep your eyes on your long-term goals.